Hey, what's going on, traders? Welcome to this video. I wanted to make a little clip, actually more for a friend of mine who kind of got caught trading the NASDAQ on the short side this morning. And I just wanted to point out a couple of nuances that I find they help me to stay out of trouble during trending markets. So let's go over that right now. So I mean, you're looking at my main screen right here, and on my other screen I've got a bit of market context. And the first thing that we need to understand here is that going into this morning, we were basically approaching all-time highs on the NASDAQ. And there's something that I've learned from my experience in trading, which is that when you're trading into an area with a lack of battle zones or resistance or a lack of market structure, basically structure that's gonna get traders in positions, stop traders out of positions, etc. So we're going into an area where there's a lack of market structure. All right, so here's the screen recording, and what we see first of all is as soon as the market opened, the market shot up. All right, and in terms of battle zones, the only one we had was on a 12-hour chart right around 15,135 to 140 zone. That was, in my opinion, the area that needed to be held by the bears. And since we've pretty much gapped through that on the open, as soon as the market opened, it shot through this. We know right away that there's not a lot of bigger picture structure to be leaning on if you're looking to short the market. So generally speaking, it means be very cautious taking short trades, and you want to sit there and watch what's happening when sellers hit the bid. How does the price react to it? So I didn't trade the morning out of this session, but if we just look at what happened, this is what we see. The market shot up. We see an initial pullback, a pretty large pullback, and I wasn't watching it when this happened. And then it slowly chopped and then slowly bid its way back up. So this is kind of the activity you will see when the market is trending. You're going to see a lot of sellers hitting the bid. Look at these large imbalances here. And again, right there, a minus 500 on the micros. And if you can see it as well, right here on the footprint, where traders are getting kind of caught around that 48 bid. We trade through it again, but again, sooner or later, what we end up seeing is the market shoot up and make a new high. And if I repeat throughout the session, you're going to see a lot of this type of activity. And again, really, there's no joy in holding a short trade when there is clearly no market structure to hold the price down. Okay, so anybody who's holding into a short trade after the high has been breached, after the area has been breached, you're basically really gambling. And it's like basically what you're doing is you're paying traders that are more experienced than you, or who got the long trade basically. So again, here's another example. We're watching the market here. Now we're starting to trade around 179, give or take. And what you'll notice is that the pullbacks are very light. So we have just some very light consolidation, and it goes for a new high. So again, this is an example of a trending market. Another nuance that I like to look at is just simply look at either a 5-minute or a 15-minute chart. So right there, you have every single bar in a row with a higher close. Nowhere here are the bears ever getting tested. Now, a lot of traders don't trade on a 15-minute time frame. You guys trade on shorter time frames because you're scalping. Look at the 5 minutes, same idea. So all this says is that the market is just going higher. And if you look at the profile, we're continuing to build value at higher prices, builds value, higher prices, builds value, single print, higher prices, builds value, higher prices, slow and steady. And that's where a lot of traders can get tricked into taking a short trade, is when they start to see the market kind of doing that slow and steady movement. But really, that's the dangerous movement. It's called the death grind, and it works in both directions. So, you know, that's one way of filtering out. So 15-minute bars, 5-minute bars, one-time framing, meaning all the bars are closing in the same direction. And even if we get a test of the previous bars, low or high, it always regains it and ends up closing higher. So for me, when I see this, I do not even think of fading it. That's one filter I have. I do not even think of fading it at all. There's a few other more advanced ways that you can use to determine if you should be fading it or not. And really, it's not very complicated, but a lot of times if you can identify where your pivots are on the session, if you can identify the volatility and where the pivots are, a lot of times the levels that need to be breached are pretty clear. And a lot of times you'll get this type of really slow absorption at the price, and then it's going to start bidding its way back up slowly. and you really don't want to be staying in the trade when it's slowly bidding up against you if you're trying to short it. So little nuances like that, and again, I might be talking a little bit vague sometimes, but you guys have to kind of see the picture here. So just look at the picture of the session. So it shoots up, consolidates, shoots up, consolidates, shoots up, builds more volume, consolidates, shoots up again, consolidates, tests the previous value a couple of times to stop out some weak hands, slowly bids up, going for a big move up again. So holding the previous areas where traders are getting kind of trapped, and you can see that on the delta figures as well. So look right there, minus 167, minus 44, where these sellers are kind of getting trapped into trades, and then the market's slowly going away from where those trades were, you know. I caught one trade, I'll show you where I caught it, right around 200 offer. So this is what the market was doing. We were basically at 195 to 197, give or take. The way we had traded prior, it was just indicating to me that this even number was about to get run through. I didn't know how much it was going to get run through, but judging on how much time we spent here, and we had these pullbacks, and then we're just kind of consolidating, there was, in my opinion, a very good chance that this even number was about to get run through. So I jumped on it. I managed to get filled at 199.25, and for some reason I canceled all my orders as soon as that happened. I don't know why. Let's watch it again. So you can see how we traded up to 199. That's a good nuance right there. Look at this nuance. So the market had already traded up to 199. I love seeing this type of price action where we get, you know, middle of the range, 196, 195, goes to 199, comes back to 196, holds it, then goes back to 199 again. At that point, if you think that even number is going to hold, well, good luck to you, because I don't think it's going to. So I get long, get filled, someone takes out the big offer there, the thing runs. I would have got filled on my first contract there, but what I was doing was, well, I guess I got a little bit lucky. It still continued to run. I just hit the flat key and I got out on the whole trade there. So whatever, for a nice like 8-point gain on 2 contracts. It was just a pure momentum trade. I kind of messed up with my order canceling, but I'm quick with the mouse anyway, so it's not a big deal. It pulled right back in right after that. And this is typical movement of NASDAQ, make a new high, come back in to test the previous value, 195 again, high volume node. Look at these imbalances here and look at the way the market, it tests them, it holds them, slowly starts to bid up, and then sooner or later it's trading to the upper end of the range, goes for another leg down after enough buyers get trapped up here, stops them out, and then rebids again. It's still holding the same area. So guys, when you see this type of structure, you have this clear area right here. The thing is stopping out the weak hands and it's holding it on a back test, and now we're bidding up again. You really don't want to be shorting it, okay? And if you do, you're going to end up in trouble, especially if you like to average down your trades, because that can happen to you, okay? You get a nice 20, 30-point move on the NASDAQ. The guys who got long are happy to trail their stop with that. The guys who got short, if you're averaging down, that's a great way to blow your account in a day. So again, here's another example. We're trading up here. Now we have a new range that's been established, 220, 235. You can see we're kind of upward biased, right? We had this range and we're now building more volume towards the upper part of that range. So again, it's accepting a lot of trade at higher and higher prices. Tests the low, doesn't accept it, comes back, holds the upper end of the range. There was nothing here indicating to stay short biased. What would indicate short bias is something like this. If you saw, for example, let me rewind it a bit. This is what would indicate the market being a slightly bit more short bias. So we have this range, traded good volume here, comes back down to test the lower part of the range, now comes back up, tests the higher part of the range, rejects it, and now we're going back to test the lower part of the range, and we see 225 on the offer on a down tick, and it's going down. There's a good chance at that point where we can actually test out this even number here, 220. Little things like that can help you stay out of trouble. But again, what happened here is trade in this area, come up, accept trade, come back down, reject trade in this area. Watch. Traded 225 bid, held it to the tick, and now going for another up move. So when the price is just holding like that, there's not enough supply to even come down and test this area. You don't even think of holding a short trade, okay? And it works the opposite way when the market's trending down. Although trend down days sometimes are a little bit trickier because of the massive rallies that you can get on a downtrend day, because normally on downtrend days, the market is experiencing a much higher volatility than it was today. So again, little things like that. I just wanted to point out a few things that kind of keep me out of trouble when it comes to scratching trades a little bit quicker. Another thing I can point out is the delta. So for example, let's say I'm in a trade and I'm betting that whatever, let's say I was betting that this 225 bid was gonna break. And I look at my deltas and I see we get a move about 2 points below where I think it's gonna move. And then it gets met with a big iceberg. For example, about 100 to 200 contracts on the micros. It fills a lot of sell market orders that were trying to bet on the momentum like I was, and then the market immediately goes away from those orders and now is bid back up at 225, and on the delta figure you have something like minus 200 or minus 300, and now the market's slowly starting to bid up. That right there is a red flag, and I always get out. If I got caught in a momentum trade like that, I'll scratch it for like a point or two. I really don't want to be caught when other traders are clearly caught as well. Again, I want to know who's getting caught, and if I think it's me, then you got to get out. All right, guys, all the best to you. I'll catch you in the next one. Bye.